I'm going to welcome Amir Adnani up to the podium here. Amir is with Uranium Energy. Uranium Energy is a great story. You can certainly make the argument that when commodity prices are low, it is not a good idea to spend money pulling your commodity out of the ground if you can barely make money selling it or potentially even lose money selling it. So that is precisely what Uranium Energy is not doing. Instead, they've spent the bear market. They own a permitted mill. They can produce uranium very quickly and easily when they decide to, but they're waiting for the price to make it make sense. And instead, they're lining up they're getting all their ducks in a row so that they can turn on that production and take advantage of the price when the price starts to move, which, as you have heard, I expect it to do shortly. So without further ado, Amir.
Thank you for the introduction, Gwen. Good morning, ladies and gentlemen. It's a pleasure to be here. Home for me is Vancouver, Canada. Uranium Energy Corp, the company I'm going to present to you that I started 11 years ago, is a US company, and we're listed on the NYSE MKT market with offices here in Vancouver and also in Corpus Christi in South Texas. I'm going to see if this clicker works. There we go. Standard disclaimer statement. All right, I've only got 10 minutes, and I have a lot to tell you. And I think Gwen did an excellent job in outlining the near-term opportunity in uranium, especially in 2016. But I just want to add a couple of more points about it, because this truly is the year for the uranium market and for uranium prices to recover and to recover significantly. And the big part of that I really want you to remember is the fact that the bear market in uranium started in 2011. The correction in oil started in late 2014. The remedy for any commodity surplus in any market is time. It takes time to work through excess supply. It takes time to work through structural issues to get back from a supply surplus to a supply imbalance. So we've had almost 5 years now in the uranium market to work through the excess supplies, to work through the issues that the industry faced post-Fukushima. And today, not only are we looking at a market that is in a supply imbalance, but we're looking at a market that is driven by other factors than just economic growth and whether China is going to grow at 5% or 7%. We're talking about the fact that air pollution being public enemy #1 right now in China, in India. In fact, New Delhi has just gotten ahead of the biggest cities in China as the most polluted air in the world in any city. So the strategic drivers for why countries and governments are building nuclear power are really different than why an analyst or anyone would realize that, sure, we have an oil glut. There's issues structurally with iron ore. We all get that. But uranium stocks right now are priced as though they're oil stocks. And that's the baby and the bathwater effect that really does create an opportunity. Not going to go into a lot of details. I really encourage you to come and speak with us at our table to talk more about some of the details in the sector. I'm going to try to cherry pick some of the points that I think that could be additive to what Gwen covered. One near-term catalyst I really want you to think about for China. This coming March, Chinese New Year is the first week of February. First week of March, you're expecting to see the outlines of the new 5-year plan that the Communist Party puts out. The new 5-year plan, some aspects of it have been leaked out already. There's a big victory here for uranium. On top of everything that China is already doing for the nuclear sector, they're expected to go from currently building or bringing 6 to 8 new reactors online to going towards 10 new reactors coming online after 2020. And they're going to ban the development of further coal mines and coal-fired power plants. So I think come March, you're going to have, again, yet another positive boost and injection of growth demand in China. I'm going to skip India. I'm going to talk about the US very quickly. The US market is by far the biggest market for nuclear power today, and 65% of CO2-free electricity generation is nuclear. EPA is now in rulemaking to cut CO2 emissions or have utilities cut CO2 emissions by 30% in the next 10 years. Nuclear is the major beneficiary of this. And while there are 99 reactors in operation in the US, 5 more are under construction. We forget about that. And in addition to that, and this is where we really feel we're well positioned with our US pipeline of resources, US demand for uranium right now is about 55 million pounds per year. Domestic production is hovering around 3 million pounds per year. 55 million of demand in the US annually and only 3 million pounds of supply domestically. That's a great market. That's a great market if it was any commodity, but it happens to be in the US, and that bodes well for us. And just very quickly on Japan, you know, for 5 years, we've been waiting for the Japanese recovery. We used to go to meetings and investors used to say, when is Japan going to come online? Japan took longer to come online, but it happened to come online at a time where we've got this global sell-off in markets. But this is fundamentally what we were waiting for in the nuclear market. 5 reactors have been approved to come online. 2 have come online already. Yesterday's news said that on Monday, 2 days from now, a 3rd reactor is coming online. And Japan has finally passed a national energy policy that says nuclear will be 20% of its electricity moving forward. So positive developments in what really has been an overhang in the nuclear market, being Japan, over the last 5 years. You could be any commodity today. A CEO up here for any commodity would wish to have a supply-demand chart like that. We're lucky in the uranium business because you can see we have a demand profile outstripping mining supply. Secondary supplies, whether they're Japanese inventories or dismantled nuclear warheads, are done or we're getting less of them. So this supply imbalance is real, and that's a positive thing for any commodity. We have it in uranium. This is the other very constructive thing I want you to look at, the uranium price. The uranium price felt like catching a falling knife from 2011 to 2014. This is a constructive chart that we see the bottom is in. You can see the $28 a pound is where we found the bottom in the uranium market. It was late in 2014. And since then, we've had a very constructive rally. Prices are about $35. They're already 30% higher than their post-Fukushima low, and they're in an upward trajectory. This is not like catching a falling knife like it is with oil, like it is with some of the other commodities that are linked to construction and other economic activity. So some very constructive signs. And really one thing Gwen touched on, which we can't overlook, is that we're actually in a contracting cycle. Utilities that need uranium buy uranium every 5 or 6 years. Uranium makes up less than 5% of their cost to operate. They don't really care if they pay $30 a pound or $70 a pound, as long as they have it, because without it, they can't put zinc. I know you like zinc, but they can't run off of zinc. They need uranium, and it makes up a very little amount of their cost. We're in a contracting cycle. The new Chinese 5-year plan is just 60 days away. Production cutbacks, supply overhang has all been worked through the market because we've had 5 years to do that. The oil market is just starting to do that in the last year and a half. Again, yet we're trading like we're oil stocks. We're not. And uranium prices really are in an upward trajectory. Here's a picture of our company's processing plant. And other commodities, they might kind of go through a shorter timeline to get a plant permitted. Uranium business is a heavily regulated industry, especially in the US. This is what makes our company compelling from a point of view that we own and operate one of only 4 fully licensed operating ISR uranium processing plants in the United States. The replacement value of this plant alone could be equal to our market cap today, which goes to show you how beaten up the sector is and our company in terms of share price activity. It's a bit of a busy slide here. Again, come and talk to us afterwards, but I'll highlight a few things. Our share price on Friday closed at 82 cents a share. 6 months ago, we raised $10 million at $2 a share. And a week ago, when our Executive Vice President, Scott Melby, who's here, you can talk to him, he's the former president of Cameco Inc., bought stock at 99 cents just a week ago, I was messaging him saying, oh, you lucky guy, how did you buy it at 99 cents? I can't believe it's at 99 cents. And here it is, it says 82 cents. But the point is that even in the last 6 months, if you look at the insider filings of our company, myself, my executive vice president, my CFO, every member of our senior team has been buying stock ranging from $1 to $2. And we closed at 82 cents. But I'm trying to give you an indication of where our money is and how we're aligned with investors. We own 15% of this company, and not just from 11 years ago, but from recent purchases in the market. Gives us a market cap of about $80 million, Friday's close. Our major shareholders, I'll touch on them in a second, but before I do that, as a US company, we're a fairly liquid stock as well. Our average daily volume is about 1.2 million shares a day, but we're in things like the Russell Index. That's the index of the 3,000 publicly listed US companies. So you can imagine mining's not a big part of that, but technology's in there, biotech's in there, oil and gas is a big part of that. So we always also do get the effect of the market gyrations because of some of the US indexes that we happen to be in. We have $20 million of debt. It's the least amount of debt for any uranium developer or producer. That $20 million of debt is with Sprott and CEF, who also own equity in the company. Who is CEF? CEF is Li Ka-shing, the wealthiest man in Asia, and the only uranium company that he has both equity and debt exposure to is our company. They've been in the company for 4 years, and currently we have this debt facility amortization schedule is expected to start later this year. I think this is a bit of an overhang on our stock. I have confidence that in the next few weeks, you'll see an announcement where we'll have some good news with respect to the credit facility that I can also provide, in my opinion, a lift for the equity as well. But the people that are involved, the equity or the debt, these are not big banks. These are entrepreneurial, well-known resource investors. In addition to Sprott and Li Ka-shing, names like BlackRock. BlackRock owns about 6% of our company. And the uranium ETF that's also out there, URA, is a decent-sized shareholder. I'm proud of the fact that 11 years ago, as a kid from Vancouver, graduated from UBC and said, let's go build build the US's biggest uranium company. 11 years on today, I'm proud to say to you that the executive chairman of our company that just joined us 3 months ago, Spencer Abraham, pictured there to my right, is the former United States Energy Secretary. He's also on the board of Occidental Petroleum, and he also is the former chairman of Areva. Scott Melby, who I mentioned, the former president of Cameco Inc., joined us about a year ago. He's our executive VP. Our technical team in the US that have been involved with every facet of uranium exploration and mining using in-situ recovery. This is a team that understands what it took to run the Department of Energy, what it took to run Cameco, and we're all aligned building UEC, and we believe we have what it takes from a people point of view to become the largest player in the Americas. And I say the Americas because our property footprint expands 5 different US states and in South America and Paraguay. And the method of uranium mining that we use is key to this whole thing. I believe there's really 2 places to be in the uranium space today. You're either looking at exploration in Athabasca Basin because of the grade, or you're in the US focused on in-situ recovery because it is the lowest cost way of mining uranium. We've kept 100% unhedged book, which means we have full leverage to the uranium price. And that leverage comes from, this is what I really want you to look at now. In-situ recovery is what I want to talk to you about for just 2 minutes. And this is what we do. It's only 2 minutes, Gwen. But basically, here's our hub and spoke strategy in South Texas. Our hub is a fully licensed, completely constructed processing plant that we own. Remember, we don't need to raise any more money to build the infrastructure. It's in place. We have satellite deposits, in this case about 6 of them, that are going to be future feed to the uranium plant. And in fact, our first satellite project, Palangana, is also built. And so it's a matter of just turning the pumps on, and I'll tell you why pumps. Here's what the aerial view of the mine looks like. Very benign footprint. It doesn't really look like a mine in terms of what you're used to seeing when you think about open pit or underground mining. But that's what makes the in-situ recovery process so different. We have shallow uranium mineralization in sandstone, about 300 to 400 feet from surface. We're injecting water with oxygen. This is benign enough that you can basically use to brush your teeth with if you wanted to. That benign oxidized solution is dissolving uranium slowly. There's no excavation, there's no digging, there's no shaft. Uranium in solution is recovered back to surface. And in a simple ion exchange process, we separate it into synthetic resin beads, and we transport it to our centralized processing plant. What I just showed you so far there could be built, and we built it for $10 million. $10 million, you can appreciate, is the cost of a drilling program or feasibility study in conventional mining. With in-situ recovery, you build mines with $10 million. And the big thing about the advantage that we have, that Gwen touched on, that I've touched on already, is what you're about to see here, is that as a junior, we own the infrastructure. And it happens to be a brand new state-of-the-art processing facility in the heart of Texas where we can process our own uranium. In fact, we can process uranium for third party as well. This is not an animation. This is real. This is the actual video footage of our plant. And the fact that it took years, in fact, almost a decade to what would take to replicate the permitting timeline to obtain the necessary permits to have a plant like that gives us a real advantage. This is the barrier to entry for a uranium developer or miner in the US. And at the plant, what we end up recovering from uranium-loaded resin is yellowcake, the same finished product that a conventional miner would have. Today, 40% of global uranium production is coming from in-situ recovery and is on the lowest cost end of the cost curve and the capex curve for building a uranium mine. What we're doing in Texas is growing, so what Gwen touched on is that we're not just sitting and waiting for the uranium price to recover. We've invested over $10 million in exploration, permitting, and development to expand our permitted footprint that can feed our processing plant. When the uranium price recovers over $40 a pound, we're ready to turn the pumps on, inject solution, and get uranium to our fully built plant. And that's a very straightforward story. I'm out of time, so I'm going to have to skip through these slides, but I've touched on some of the key points. What we're doing in Texas is being replicated in Paraguay on a scale of 10 to 1. We have 70,000 acres in Texas, and we have 700,000 acres in Paraguay with similar geology to what we have in Texas, ISR amenable, and that's the next frontier for us that I invite you to come and talk to us about, similarities of topography. And again, at the very end, well, it's over now, but really, it's the infrastructure advantage, it's the 100% upside and leverage to the uranium price, it's the ability to quickly turn on and produce uranium in the most important market for uranium today, which is the US market, made in America uranium in the backyard for US utilities, and the energy capital of the US being Texas, with non-core assets that have published net present values over $200 million, which I didn't even have time to talk to you about today, shows you how much value there is in the company. And the fact that we've dropped 30% since the beginning of the year, and you can buy us at a discount of 65% to our financing just 6 months ago, is the irrational aspect of the market, but the opportunity that I hope this morning you appreciate and you got to see. Thank you very much.